Welcome to Live Better Longer. I'm your host, Bill Borton. As 78 million baby boomers are facing retirement, the risks and uncertainties that we face have never been greater. I like to say that a successful retirement is when your body and your mind and your money all reach the end of a long life at about the same time. This week's show I'm calling The Perfect Storm. Baby boomers were born between 1946 and 1964. And the oldest are 72 and the youngest are 55. 10,000 are still retiring every day. Survey after survey show that the baby boomers' biggest fear is outliving their assets. We are living longer, and there's a high probability that today's 65-year-old will live another 30 years. We're all living much longer, and the longevity, again, here we see how many candles are on your cake. Well, again, birthdays have been shown that the more you have, the longer you'll live. How about that? So, at any rate, that presents a host of challenges when you live a long life. Is your income going to last long enough? What about health care? And what about long-term care? And again, the longer you live, the more impact these particular issues could have. What about inflation? Inflation has been relatively low in recent years for a number of reasons. Interest rates have been low, the Fed's been controlling things, pumping money into the economy. But over time, we may very well see inflation increase. You can see that the dollar that you had in 1988 doesn't buy you as much as it does 20, 30 years later. So, what about sequence of returns? There's what's called the retirement red zone. And this is deemed to be the 5 years before and the 5 years after you retire. This is the period of time where a downturn in the market, if you're highly invested, could have a devastating impact that you might not ever recover from. Most people don't think about the long-term effects of downturns in the stock market. Here you can see the S&P 500 from the beginning of 1980 through the beginning of 2019. And you can see back in October of '87, which was the biggest drop in the market up until that time, and that was only a 30% downturn in the market. Then when we get to the dot-com bubble bursting, we saw a 46% downturn in the market. And then, of course, the big one, the Great Recession, was a 53% downturn. Since that time, we've had the longest run-up in history, 268% increase in the S&P. But things don't go up forever. And if you can see how these trends work, chances are pretty good before too much longer we're going to see another correction. Will it be 30%? Will it be 46%? Will it be 53%? Who knows? But will you be able to recover if you are thinking about retiring soon, or if you have retired in the last several years and you are relying on your portfolio to provide retirement income? The impact of losses is shown here, and you can see what a lot of people don't really understand is that if the market drops 30%, you don't need 30% to get back to where you were, you need 43%. If the market drops 40%, you need 67% to get back to where you were. If the market goes down 50% or slightly more like it did at the Great Recession, you need 100% or more just to get back to where you are even. So that means if you had 10% a year for 10 years, you'd get back to where you were in 2008. So you really would need a lot of time or a tremendously strong market to get back to where you were in the first place. That doesn't sound very optimistic to me. Boomers who, again, are in that retirement red zone need to think about keeping their powder dry, maybe taking some of their gains and becoming a little less invested than they had been up until that time. When the market tanked during the Great Recession, a lot of boomers and a lot of other people went towards bonds. And when they went into the bond market, they were doing so at a time when we had a really, really long decline in the yields of the 10-year Treasury. It peaked back in 1981. And since that time, there's been a downward trend that really kind of hit the bottom again back in February of this year. Since that time, yields have been going up slightly. Now, when bond yields go down, generally bond prices go up. There's an inverse relationship. And when bond yields go down, interest rates on mortgages tend to go up. When yields on bonds go up, interest rates on mortgages tend to go up. It tends to really slow down the economy. A significant increase in interest rates could trigger the next recession. So the government, the Federal Reserve, the Treasury, everybody is trying to manage all of this. And again, we're in an unprecedented time with bonds, with the stock market and such. And we have these 78 million boomers that are trying to manage living a longer life. And again, this is why I refer to this as the perfect storm. So if we end up really are in a bond bubble, and if something causes the bubble to burst, and we end up with people's bond funds being worth a lot less, this again could trigger a real problem for a lot of baby boomers. So now what? Now what do we do? What most people have been focusing on for the last really 30, 40 years as they've been going through their career is accumulating assets. They've been saving and investing, and they may have money managers or portfolio managers or financial advisors who have been working on growing their assets. We all know about accumulation. That's really what everybody's been focused on. But what most people and many financial advisors really aren't very good at or clear about is what I call giving the money back. In the industry, they call it decumulation, or distributing your assets over a period of time in such a way that you don't run out before you pass away. So there are a number of priorities that we have here, one of which is to create a sustainable retirement income plan that will last as long as we do. And the second is to manage the risks that can be managed along the way, such as unexpected health care costs or long-term care costs. What we're seeing here is a graphic that represents the three most commonly talked about, commonly recommended retirement income strategies. The safe withdrawal strategy is probably the one that most people are familiar with. It's what most financial advisors talk about. This is the one where using a number of different assumptions, inflation, taxes, Social Security, advisors will say, gee, if you retire at such and such an age and you need so much money per month, and we have you invested in dividend stocks, and we create bond ladders and other different strategies using tips and things like that, we can create a way that you can safely withdraw a certain amount of income from your portfolio, and you won't run out of money until, say, age 95. And they run these Monte Carlo simulations that tell you what your probability of success will be. These don't leave a lot of my fellow boomers feeling very comfortable because, again, there's no guarantees. How conservative will you be, or how aggressive will you be? If you're too conservative, you may end up with a diminished lifestyle and end up leaving a lot more money in a legacy to your family members than you had intended. If you spend too much, you may have to really dial it back later or risk running out of money. The bucket strategy on the right has been talked about a lot more lately, and this, I like to say, is a way that you can kind of divide up how you're investing your money so that you're investing the portion of your money for what are called the go-go years in the first bucket. In the second bucket, you invest a little bit longer term for what are known as the slow-go or go-slow years, when maybe you're not as active running around, taking cruises, going to Florida, seeing the grandkids, and doing those things that you can do while you're vital and happy and healthy after you retire. And you want to kind of stay closer to home and slow down. You tend to spend a little less money during the go-slow or slow-go years. The third bucket is the one where you put your long-term money in and possibly get a deferred income annuity, And this is for what are called the no-go years, when you start to get old. And this again is the time period when healthcare costs and long-term care costs can really put a lot of strain on your retirement income if you haven't planned while you're younger to again be able to transfer some of that risk to an insurance company. I like the flooring strategy. This one's been talked a lot about lately. This is where you create a base of guaranteed income that you can't outlive, starting with Social Security. If you're fortunate enough to have a pension that goes along with it, and to the degree that those combined don't provide a sufficient amount of monthly income to cover your basic living expenses, you buy some type of an income annuity. Yes, that's right, an annuity. They are not four-letter words. More and more people are beginning to understand that the combination that you get with an annuity of not just your principal and interest the way you do with a bond, but having the mortality credits that only an insurance company can deliver stand to be able to keep that money coming no matter how far you bend that life expectancy curve. So the idea, however, is you don't put all of your money into annuities. That would be folly because most of them don't keep up with inflation. And so once you calculate how much guaranteed income you need for that combination of Social Security, pension income, if you're fortunate enough to have some, and an income annuity, the balance of your assets get invested. And because you could replace a lot of your bond portion of your portfolio with an income annuity, that leaves you and or your advisor to go a little bit longer or more aggressively with equities, which really helps cover the impact of inflation and any unexpected capital expenditures that you may not have planned for. This again is where you give yourself basically a paycheck in retirement for the basics, and this is where people tend to be a lot more confident and sleep better at night knowing that you're just not going to run out of money. This is my approach. This is what I'm planning on doing for myself and my wife. So the next step that I want to talk about, again, is how you take a look at some of these strategies. And the one thing that everybody talks about a lot is the 4% rule. The 4% rule was introduced back in 1994 by a guy named William Bengen. And he proposed that a 50-50 blend of stocks and bonds would allow a client to withdraw 4% per year, adjusted for inflation, and have a 90% chance of lasting 30 years. You know, that's kind of like a 10% chance that it won't. One of the reasons why the safe withdrawal strategy means that you got to be really careful about how much you actually take out. What would you think if you went to the airport and you got on a plane and the pilot came on board and said, you know, we've got a 90% chance that we're going to make it to Kennedy Airport? Would you want to get off that plane, or would you be okay with a 10% chance you weren't going to make it? It's been the holy grail of distribution planning for the last 20 years. However, in 2008, Nobel laureate William Sharpe cast some doubt on the 4% rule. This was reinforced by a study done in 2013 by Dr. Michael Fink, Dr. Wade Pfau of the American College of Financial Services, who are renowned retirement researchers, and Morningstar researcher David Blanchett. They claimed that Bengen's 4% rule was based on 20th century data that will not hold up in the 21st century. They also found that based on current models, the 4% rule would have an astounding 50% failure rate. That doesn't sound very good to me. So, what do you do if you don't want to go along with the systematic or safe withdrawal strategy and you need either the bucket approach or, better yet, in my way of thinking, the flooring strategy? Well, now again we need to start thinking about annuities. And there's a type of annuity that's been around about 20 years, and it has really kind of reaching into the third or fourth phase of its evolution, called fixed index annuities. Now, fixed index annuities have been talked about by a lot of people. However, some of the real experts out there, people like Roger Ibbotson, who is a renowned retirement researcher and has really received a lot of positive press back in about a year ago when he published a research paper, And he suggested that uncapped fixed index annuities could actually outperform bonds in the long run. And so this has really kind of breathed even more life into these types of annuities. And some of the companies that I've been working with, a firm called Annexus, have developed some really, really sophisticated, what I call fourth generation index strategies. So let's talk a little bit more about fixed index annuities and some of what you can expect. So, first of all, understand that fixed index annuities are not investments. They are insurance contracts. Your money's guaranteed by the assets of the insurance company, not by the Federal Deposit Insurance Corporation. You get tax-deferred growth with an annuity. Contrary to what you hear by all the naysayers, there are no fees. There are, however, surrender charges, so you don't put money into these investment or annuity insurance contracts thinking you're going to get your money out next week. But you do have some liquidity through penalty-free withdrawals. And they vary from 5, 6, 7% up to 10% of your accumulated assets per year. One thing also to know is that, again, these are fixed annuities with the opportunity to receive higher crediting than the current fixed interest rates that most fixed annuities pay. Interest is actually credited based on the performance of a market index. But you're never invested in the market. The insurance company buys options to participate in a market index without being in the index. If the index increases, you get a portion of that increase as excess interest. This is where you get the opportunity to participate in the index performance and potentially get a higher rate of interest credited to your account while it's accumulating before you start taking retirement income than you would in a traditional fixed annuity. Now, some of you may have heard of folks that are selling a lot of annuities by bringing people in to educational dinner seminars, buying you dinner, and then pitching you on crash-proof retirements or ways that you can get market returns with no risk. That's never going to happen. Even the best fixed indexed annuities, while they're going to hopefully participate in the indexes and get you better returns than you would in a regular fixed annuity, you're not going to get double-digit interest rates every year. Over time, we might expect them to perform similarly to the S&P. So some of these newer generation indexes may end up doing 5 or 6% over the long haul. You're protected on the downside. You're never going to lose any money if the market tanks. This again is where you can kind of stave off losing some of your nest egg due to a market downturn, which is, again, one of the reasons why a lot of boomers are moving some, but not all or even nearly all of their invested assets into these products, because you are, again, getting tax deferral, you are getting protection from downside risk, you're getting some reasonably decent upside potential, and then as you reach that point where you now need to supplement Social Security to create that floor of income that you can't outlive, you can turn the income on through a number of means with these products and receive that lifetime income that gives you that peace of mind. There's also a death benefit that can be paid to your beneficiary and bypass probate if you were to die before you spend down the money that you've invested in the annuity. So the insurance company with these products does not keep your money if you die, which is, again, one of the reasons why people think annuities are a bad deal. So what I would like to, again, call your attention to is the perfect storm. And here again, we know that the baby boomers are aging, they're living longer, inflation is going to have some kind of an impact. 3% inflation over 25 years halves the value of your money. We're looking at the retirement red zone where the downturn in the market and your portfolio before and after you retire could create a problem that you might not be able to recover from. We're looking at the likely correction sometime in the foreseeable future in the market. We're looking at the potential for negative impacts from a bond bubble. And we see that the 4% rule is really in doubt as being a really viable benchmark these days, and that annuities, in particularly fixed index annuities, might help be part of the solution. So, what I would suggest to you is, if any of you would like to talk to me about how you can manage risks in retirement and create a sustainable retirement income plan, that you can reach out to me, and either by going to my website, wrborton.com, you can email me at bill@wrborton, or you can call me at 856-817-6100, and I would be happy to have a no obligation conversation with you or you and your spouse and help you to understand the details around all this and more. Again, with no obligation whatsoever, no sales pitch, simply a consultative conversation where we determine what matters most to you and how I can help you to create a retirement plan that helps you to live out your dreams and, again, get your body, your mind, and your money all to the end of that long life at about the same time. Until next Tuesday at 11, this is Bill Borton at RBN TV for Live Better Longer. Thank you for watching.